Good evening. It's been a little while since we've asked you guys to join us for an informational webinar, but we're glad you're here. A lot has happened in the world since our last webinar. For starters, we hope most of you have now received at least your first round of the COVID vaccine. Congress has passed another huge stimulus bill, and just hours ago, the president was impeached for a second time. It is definitely a crazy time to be alive. We have a lot of content to cover this evening and several panelists that are going to be speaking. This evening's lineup is going to include all the major discussion points related to the recent passing of the Consolidated Appropriations Bill of 2021, including round 2 funding of the Payroll Protection Program, PPP forgiveness, the ERC, and more. And our panelists this evening are going to be MLW planners Miles Kellum, Jason Luse, Michael Womble, Jackson McDaniel, and Chris Carroll. They're going to be informing you on the given topics and answering your questions live. Speaking of which, if you have questions for us, please use that Q&A feature located in the application. We're going to answer the most commonly asked questions live, and we also have a separate off-air panel that will be responding to some of your questions via that Q&A function. As a reminder, we won't be using the chat feature. Miles, we'll start with you on our most anticipated topic, PPP second draw loans. And for those of you that don't know Miles, he was the friendly face that was dancing just a moment ago when he didn't realize his camera was on. Miles, take it away.
Hey, everybody has their pregame routine, and you know, that music was just too funky. As we're pulling up our PowerPoint here we go. So yes, perhaps the biggest news for most everybody was that PPP is back. I don't know whether to cheer or to cry, but I'm happy that small businesses are getting money and that we're able to support them in that capacity. So there were two aspects of this. Let me jump in and give you all some of the high-level details of this program. It was both an extension and an expansion of the PPP program. And what I mean by that is the extension was an extension of the timeline to apply for your first draw loan. So for some reason you didn't get a first loan back in April or May, perhaps you didn't think you qualified, perhaps you were a new business and your 2019 payroll was not substantial, something like that. There is a new opportunity to apply for a first loan, and you can even use your 2020 payroll if it results in a larger loan. However, for most of you, probably the most applicable one here is going to be the second draw PPP loan, what a lot of people are calling PPP2. And that is for businesses that previously received a loan back in April, May last year sometime, and now can qualify for additional funding. So let me say that again. Yes, this is additional funding. This is a second loan that is very similar to the terms of the first one, that is additional money that can come to your business here in the first quarter of 2021. Couple of changes and highlights of this program. First off, the maximum loan is $2 million compared to $10 million in the first draw. Now, for most people tonight that are small businesses watching this, your loans are significantly smaller than this. But the takeaway here is the really large businesses that kind of sucked up all the money, especially in April when this program first came out, a lot of them are phased out. They're capped on the loans that they can get. And it should help this program be dispersed a lot more broadly, reach a lot of the smaller businesses that maybe got shut out or delayed that first time. The deadline to apply is March 31st. So it's pretty much a Q1 at this time. It could get extended. It's a Q1 program. And overall, the terms and conditions are generally the same between the first and second draw loans, except for a few key places where the CAA bill expressly changed those. So for example, it's the same 8 or 24-week covered period option as we had with the first draw loans. Most people, barring some odd circumstance, are going to want to probably use that 24-week period, because if you do, it's going to give you 6 months, functionally 24 weeks, to spend 2.5 months worth of payroll. As long as you can do that, that's a relatively low bar. This should be eligible to be fully forgiven, just like the first loan is, and is as close as it gets, I suppose, to free money from the government, if you will. 60% of the money must be spent on payroll. Again, I think the most direct path to utilizing all of this is probably to spend the whole thing on payroll, but the other 40% can be spent on rent, utilities, certain other things that Jason's going to get into later tonight, in the forgiveness section. Now, moving on to our next slide here. Yeah, let's talk about some of the eligibility requirements. I'm going to go pretty quickly through this. If you're an MLW client watching this tonight, know that we have run this analysis for you. So I'm not going to get into the nitty-gritty details. Mostly I want to get into the instructions here in just a second on how you need to apply for this with the bank, walk you through some details there. But high level, some of the changes here. On PPP1, it was 500 employees or fewer. For this second draw loan, it's 300 employees or fewer. Again, the takeaway here from the size of the loan to also the number of employees, the biggest businesses are going to be less likely to qualify for this one, meaning there's going to be better and more access for our smaller businesses that are applying for this program. In order to get that second draw loan, you must have received a first PPP loan and fully spent or will spend the money from the first one. Now, the latest you could have gotten a PPP loan prior to this was in August. So presumably anybody that got that first one that was operating, had payroll, again, most dental practices should have no problem clearing that hurdle. Maybe if you were a restaurant or something that was primarily shut down and you had money left over, I think for our clients, our audience tonight, this shouldn't be too much of a hurdle. Now, let me address one rumor that we're seeing go around. In fact, we're even seeing some bankers toss this out. It is erroneous. You do not, let me repeat, do not have to have your first PPP loan forgiven in order to apply for the second PPP loan. That is not what the bill says. It says you had to have spent it, not had it forgiven. So if your banker is telling you, or you're hearing from a friend or whatever, that you've got to go rush and apply for forgiveness in order to get the second loan, that simply is not accurate. It's not what the SBA is saying. If your bank is insisting on that, reach out to us. There are other resources available. We are developing some partnerships with some different groups that can help our clients get additional access to loan funding opportunities. So if your bank is being difficult to work with on this, let us know. We've got other avenues. We don't need to get bogged down, because as Jason's going to talk about later and Jackson's going to cover later as well, there's a new forgiveness application that's coming out, and there are significant considerations to the way this is going to affect potentially the employee retention credit and other aspects. And so not only is it the old form, but you could potentially do damage to your access to other benefits if you rush and apply for forgiveness today. Now, if you've already applied before this bill, that's okay. I think there's going to be a dividing line. What I'm talking about is people sitting here on January 13th that haven't applied for forgiveness yet and are thinking about when they need to do that. Focus on your PPP2 first. Focus on that application. You can certify that you fully spent the loan money from the first one. And then here in a few weeks, when the new one comes out, when the details of the ERC come out, then it's going to be time to apply. So just hang in there when you're applying, and certainly reach out to your MLW planning team if you're getting any additional feedback from banks. And the final requirement, and this is the one that's going to catch a decent chunk of people. In our experience, about 20%, 20 to 30% of the dental practices we're looking at are getting phased out by this. There is a requirement that you must have experienced a 25% or greater reduction in revenue for any quarter in 2020 as compared to the same quarter in 2019. So to give you an easy example there, for most people, it's going to be the second quarter when we were shut down, quarantining, that sort of thing. That's your most likely candidate. So if in the second quarter of 2019, you collected $100,000, and in the second quarter of 2020, you rebounded at the end of May and June and did okay, but you still only collected $70,000 for the whole quarter. In that example, that's a 30% reduction. And so that business would qualify for this second draw loan. For our MLW clients earlier today and this week, we uploaded statements for you guys to your ShareFile account that shows and supports this. So for our clients that are watching, you should be aware whether you qualify or not. You should have the supporting details to back that up. So hopefully that is helpful for you guys as you're applying here. There are alternative calculations. I won't go too deep into those, but if you were a non-traditional business, meaning maybe you started up in the third or fourth quarter of 19, and so you didn't have much history to rely on to compare your quarters. Same thing if you started between 1/1/20 and February 15th, 20, which is when they've kind of said officially was the government definition of the start date of the pandemic. Certainly you can also use some alternative calculations. So if you're unclear, reach out to your MLW planning team and they can help guide you through those calculations. So for the loan amount, this is a big update. You can now use either your 2019 or 2020 annual payroll in the calculation of this loan. Now, in the test that we've run for our clients, the majority of offices, not everybody, but the majority are going to be better off using the 2019 numbers. And the reason for that is because of that 4 to 12 weeks of pandemic unemployment that a majority of you had during 2020. It kind of shoots a big hole in your annual payroll numbers. And so even if you increased hours when you got back or added an employee, because of that missing chunk, we're finding probably 2/3 or more of our clients are utilizing that 2019 payroll number. But for some, maybe you had just expanded your office, maybe you brought on an associate or something, it is certainly possible that you may be able to increase your second draw loan by utilizing those 2020 numbers. Salary is still capped at $100,000, no changes there. So for an owner doctor, maybe an associate, something like that, the max W-2 wages for that employee is $100,000. And just a reminder, you can include company retirement contributions, health insurance, state unemployment tax payments in that loan calculation. So there's a few add-ons above and beyond just the salaries that you paid to yourself and to your staff. And that loan calculation is the same as before. You take your annual payroll plus the add-ons, divide it by 12, multiply that by 2.5 months. That's your PPP2 loan. So when we're running that analysis, that comparison, we're looking at that calculation for 2019, that calculation for 2020, whichever one's bigger, that's the one we're going to want to go with for our our largest possible PPP2 loan. All right, a question we're getting a lot: where should I apply? So let's talk about a couple of things, couple of factors that we're seeing this week. You would think at this point we would be rolling this process out more smoothly as a country, from Congress to the banks to the SBA. Like, we've done this once before, are we better at it? Turns out perhaps not. There's been a lot of confusion, a lot of misinformation. It seems like the SBA sort of jumped the gun and rolled this out ahead of schedule and then delayed it today. So just this afternoon, the SBA announced they're pushing back the start date of the applications. It was originally going to be Wednesday and end of the week, and now they've changed it. So small community banks, which they changed the definition, instead of under 10 billion, it's now under $1 billion in assets. So we're talking really small lending institutions can now begin accepting loans on Friday, the 15th of January. Most banks, the larger banks, and things like that, because of the holiday on Monday, will begin accepting applications on Tuesday, the 19th. So when you're deciding between those two, I think it's generally good here. We're only talking about essentially a single business day of separation between the applications. If you've got a relationship with a small community bank, I think that's wonderful. Certainly we love these smaller institutions. I think they did some great work with underserved communities and other areas in the first round. But one of the examples that I was reading about from the first round was a community program that did 100 loans, and they processed them by hand with a 10 key, to get this calculation. So this idea, do I need to rush out and go find some tiny mom and pop shop and apply there? I think they would get overwhelmed even faster than the big banks got overwhelmed in the first round, simply because of they're not sophisticated per se. They don't have software applications and other things they can use for this. So just a heads up, if you've got a relationship with one, I think that's a fine place, but I also don't think you need to abandon your larger bank to go find a secondary one. And I will say, as we're going back now and looking at those first draw PPP loans, the ones that had a lot of calculation errors, maybe somebody didn't get as much as they could have, maybe something was added back accidentally, primarily that did come from the smaller banks. Not trying to call anybody out, but they just can be a little under-resourced at times. So in my opinion, probably the best place to start is the bank where you got your original PPP loan from. And the reason I say that, one, there's already a familiarity level between you and that bank. They've already got you in their system. But also, the SBA has authorized, if you're using your 2019 payroll data to get the same loan as you got back in April or May, so you're essentially just saying, roll out another one of those, please. The bank can simplify and not have to request a ton of additional information. So it may be your fastest path to being able to apply and move forward with a second draw PPP loan. So this is the part I definitely want to cover, especially for our MLW clients that are watching tonight. We have uploaded to your ShareFile portals everything that you should need, and even a little extra in case the bank asks for it, everything to be able to apply for it. So what I want to do now is walk you guys through the actual application. Now, some banks use an online portal and varying iterations of this, but the fundamentals here should be the same, especially some key details. So this is the top portion of the application, and I've circled a couple of things here. You are going to want to choose the entity type that matches your tax return that you file. And that's a little bit confusing because it differs from the way you might fill out a W-9 request or something else like that. So if you are an S corporation, even if you're an LLC or PLLC, but you file an 1120S S Corp tax return, you're going to want to check the S Corp box. If you happen to be a C Corp, 1120, perhaps an older practice, you would check C Corp. If you're a multi-owner LLC, you're going to check that partnership box. If you file a 1065 tax return, that's the partnership tax return. And if you file your business on your personal tax return, meaning just as a Schedule C on your 1040, generally speaking, you're probably an LLC if you've got one set up, or perhaps an independent contractor or sole proprietor there. So this, what we've learned, the SBA and the banks are using this to match what you check here with what they would expect your tax return to be. And so we want to make sure those match up on your application. Doing business as or trade name, if you've got one, year of establishment, hopefully that's familiar to you. If not, and you file a 1065 or 1120S, it is on your tax return. Your business legal name is also on your tax return. You know, just to highlight there, doing business as, you know, if you're MLW Dental Smiles doing business as, you know, MLW Dentistry or something, make sure you put that official legal name that goes on your tax return in the business legal name there. NAICS code, this is a new one they're asking for this time. This is so they can find restaurants and other people that qualify for some expanded loans beyond just the basics. Here, if you are a dental practice, your NAICS code, I'll just give it to you. It's 621210. Everything else I think is relatively straightforward on this one, so we'll move on to the next section here. All right, at the top of this one is familiar from before. Again, for our MLW clients, we have spit out exactly the average monthly payroll number you need to use. You'll input it there. It's going to multiply by 2.5 to give you the requested loan amount. In our cheat sheet that we uploaded for you, we have also calculated that loan amount. I highly recommend you make sure our cheat sheet matches what the bank application is spitting out. If it doesn't, I would encourage you to look into that, reach out to your planning team if you need help. Some of the errors that we saw, there was the wrong number here, they checked a box somewhere else on the application and it somehow lowered it, and the client got less money perhaps than they could have. So we've tried to make that as easy as possible for you and given you the resulting number that should come out there. Number of employees would be your active employees, including yourself, that are in the business at this time. And then the purpose, they're looking for the 300 or fewer employees, by the way, is what that's for. Purpose of the loan, I recommend checking payroll costs, rent, mortgage interest, utilities. You can check the operation expenditures and supplier costs if you want. It doesn't hold you to that. It's just categorizing what you may be utilizing these for. Unless you have property damage, I probably wouldn't check that one. Worker protection expenditures, that's for PPE. You could check that as well. Shouldn't affect you too much one way or the other. Now, I've highlighted or circled on this one a really important item, your PPP first draw SBA loan number. I've been working with several clients from my team today to try and run these down, and we're having a hard time with it. If you're applying at the bank that you got your first one from, they should have access to it. So if you're reapplying there, you should be in good shape. In fact, I'm hearing some of their portals may automatically pull that for you, which is nice. The issue we're seeing is, I think back in April and May, banks were pushing the e-signature documents out so quickly and then trying to get it through the e-tran system that a lot of those loan documents got out to you, at least the initial ones you received, before they had the SBA e-tran loan number. And as a result, that section's blank. So even if you have your loan document, you may not have the SBA number. My client today had found a subsequent one the bank had sent to him a couple months after he got his first loan document that was an updated one, and that one did contain the SBA loan number. So if there's something I want you to be doing now, meaning over the next day or two, while you're preparing perhaps for Tuesday for applications to begin, it's hunting down this first draw SBA loan number. You're going to want to have that. Every bank that I've kind of preliminarily seen the access to so far will not let you proceed with the application until you put in that loan number, because they have to match it up to prove that you got a first round before they'll issue the second one. So make sure you've got it. Right below that is the reduction in gross receipts test. Now, if you read the fine print here, what it says is that if your loan is below $150,000, you do not have to submit this information until the time of forgiveness. In our conversations with some of the banks that are accepting these applications, many of them were very encouraging of the idea that you go ahead and submit this at the time of the application. Some were saying they were going to require it anyways. Others were just saying they encourage it. I understand it's useful to input this information so you can track which quarter is your reference quarter, which quarter had the decrease that you are declaring was greater than 25% and made you eligible. MLW clients, again, in your portal should be a supporting P&L that will give you the information. We ran one that compares quarter by quarter for 2020 and 2019, and it even shows the percentage reduction. You can copy that information off of here to drop into the application, upload that P&L as your supporting document. Should be nice and easy for you there. And then the last item on this bottom portion of the application is the ownership attestation. And if you're just a single owner, you own an S Corp and you operate out of that, you're not going to, you're just gonna put yourself in that case. So, you put your name, title if you're an LLC or PLLC as member, ownership percentage, probably 100 in that case, and you'd put your social security number and address. Where this gets slightly more complicated is if you're in a partnership arrangement. So if you're a partnership owned by a shell and then the individual owns the shell S Corp down below, for that partnership application, you're going to want to put the names of the S Corps of both partners. And you would fill that in as maybe 50-50 owners, put the EIN there. And then on the shell application is when you would put your individual name. So just a heads up, each bank may be a little bit different on their application of how they input that information, but if you just think through logically, your equity structure should be fairly logical there. Now, that's the end of the application input side. After that's a bunch of attestations that the banks are going to ask. You can initial, sign at the bottom, should be good to go. So now let's move to the part that everybody wants to know. Will this program run out of money? Now, of course, I don't have an answer for you on that tonight. In fact, there was part of me that was tempted not to try and become a internet meme and say, there's no way it'll run out of money, and then it runs out of money on Tuesday. However, I do think I need to share some information, some details with you guys tonight to help do my small part to perhaps ease a little bit of the panic or concern that may be out there on this program and hopefully help you guys feel a little bit more confident. And to do that, let's start back with the first round. This lovely breakdown that came from SBA information that the New York Times put together. Let's look first on that right side, the share of the money that was distributed. What we can see is those largest loans, the loans over 1.5 million, accounted for 25% of the total amount of money that was given out under this program. It was roughly $130 billion. Of the remainder, if we look at on the left side of that graph, the loans under 500,000 and under 250,000, those totaled about half of the money that was given out, 262 billion. So those like 600 largest loans that were given out, and overall those loans over 1.5 million accounted for a ton of the money. That's the money that got siphoned off quickly at the beginning of this program back in April and caused it to run out of money quickly. And as I was sharing with you earlier, a lot of those companies are not going to be eligible because they were larger, because they had more than 300 employees, or also simply because they didn't experience that 25% revenue drop. If it was a tech company or a law firm or whatever that generally kept on operating, working from home, whatever the case was throughout the pandemic, they may have been eligible for that first draw PPP loan, but they would probably in that case not be eligible for the second. So we've carved off a pretty healthy amount of the people who would have otherwise qualified for this. And it's these small businesses that we are trying to allocate the majority of the funds. So in that first round, again, with all the large businesses and everything else, although there was a total of 600 that was available of the program, they actually ended up returning $100 billion from the PPP program at the end of the year of 2020. When it ended in August, there was nobody left to claim it. So the original one ended up dispersing $523 billion. This new one was refunded or reallocated $284 billion from this new bill. So when we carve out the largest companies that aren't going to qualify, those that didn't have a revenue dip, that won't qualify, 284 would be more than went to the smallest businesses that all qualified, all the ones that qualified in that first round. So there's some data about whether it's going to run out. I do feel pretty confident that this thing is going to be available. Congress has generally been willing to indicate that they would refund it if this does happen to run out of money. So do I think you need to wait till March 29th to apply? Of course not. We've got all of our MLW clients ready to apply as soon as this thing goes live, but I don't think you need to lose sleep or panic or concern yourself if you can't get a loan first thing Friday morning from a tiny bank or on Tuesday, or something like that. I do think there's a little bit of time to let this thing play out, be a little bit patient with the process, and work with your bank on that. See our overview and recommendation on the PPP2 program.
Excellent. Thanks, Miles. I know we've got a lot of content to cover this evening, so we're going to kind of keep the ball rolling. We don't have any immediate questions, so obviously you're doing a great job, or everybody's received their emails from their planning teams, which is obviously going to be helpful for their specific situations. But piggybacking off of the main point and discussion of tonight, which is the PPP2, those second loans, we do have a lot of questions we've been getting over the last few months about what's going on with forgiveness. And some teams have started moving through that forgiveness process. Others were sort of waiting to kind of see where we were going to land with some of this legislation. We want to get the updates on what's going on there and whether or not the CAA made any changes to the round one forgiveness. So Jason is going to take it from here and help us out on that topic.
How are y'all doing? Hope everyone's doing good tonight. It's been a little while, so it may take me a few minutes to get warmed up here. So tonight I'm going to talk about PPP loan forgiveness on the first round and kind of walk through that process a little bit. I know there's some people are real antsy about it. I've had several clients that just can't, for whatever reason, deal with the fact that they have this loan that is unforgiven. So I want to talk a little bit about that process, what it looks like, the experience we have. Just to kind of get a feel for it, I did work through quite a bit of these forgiveness applications in December, just to get a feel and see if I could give some input back to the firm and to clients. So I was a good person to take this topic and kind of run with it. So we're going to dive into forgiveness. So we're talking about round one forgiveness here. A lot of us got money back in, middle of 2020. We spent the money over our covered period, and now we need to seek forgiveness on that. One note that I do want to make that's been pretty consistent with all of the legislation that has come out. It seems like the feds continually make updates to these programs to make them easier. And so a lot of times we dive into the program and we find we don't know how to calculate this stuff. The banks don't understand it. We can't get this done. We can't get it through. There was some misunderstanding on the way it was calculated on the front end. It seems like every time we work through this process, the longer we work through it, the more and more they make it easier and fix some of those problems that we've had. So I just wanted to make that note that we're in a lot better position today than we were back in May. So on the forgiveness front, there was some speculation going around that there would be an automatic forgiveness, that, hey, if the loan was under 50,000 or under 150,000, that you get automatic forgiveness. Unfortunately, the latest legislation did not grant that automatic forgiveness. Each borrower will have to proactively apply for forgiveness, okay? And if you go back and we think about the loans, we got the loan, and then we had to spend, just to remind you, we had to spend that money on particular costs over a covered period. When we first rolled this out, they were talking about an 8-week covered period. They since added an option to extend that to 24 weeks. So once they added that to this legislation and these bills, extending that to 24 weeks, it made it a lot easier to get that forgiveness. You know, by the time you add your staff back on payroll, pretty much I have yet to have a client that needed to claim any other expenses other than payroll in their forgiveness application. So when they added that 24-week, it really made it a lot easier to get forgiveness on this. So most businesses will want to take that 24-week, and that 24 weeks started on the day the money was deposited into the account, okay? There is an option on top of the covered period. You can choose 8 or 24 weeks. You can also choose between what we call an alternative covered period, okay? The alternative covered period is the first payday of the next pay cycle after you got that money. I know that's clear as mud and that's hard to follow, but the intent of this provision was to, if you're a biweekly payroll payer, so you pay your payroll every 2 weeks. Well, if we're working in even weeks here, whether it's 8 weeks or 24 weeks, then theoretically, we should be able to fit 4 perfect payrolls or 12 perfect payrolls into those covered periods. But if we receive the money in an off cycle in the middle of a payroll, well, that would be impossible because we would be splicing off the front end of a payroll of a week on the front end and a week on the back end, and we'd have this odd period where we had to measure payroll. So the benefit of that alternative covered period is that we can take when the money was deposited and then move that to the first day of the next pay period. So let's assume we're going to use the 24-week pay period here. This allows us to get perfect 12 payrolls. Why does that matter? Because it's super easy to run reports when we're talking with clean 4 or 12 payroll periods. And so that's the benefit of that. Now, if you did choose the 8-week covered period, I don't know many scenarios where that would make sense. It's incredibly important that you use the alternative covered period. So in most cases, we want to use the 24 weeks and we want to pick the alternative covered period and use start our covered period the first day of that next payroll. When is the deadline to apply? I started getting a bunch of panic emails and texts. I would say in November, December, there was a lot of misconception on when the deadline to apply for forgiveness is. The deadline to apply is 10 months after the last day of the borrower's covered period. So we're going to think about that. If we got our money, just as an example, on May the 7th, and let's say that the way our payroll cycles run, we choose the alternate 24-week covered period. So let's say we start our 24 weeks on May the 12th. Okay, so from May the 12th to October 25th is our 24-week covered period. All right. The deadline to apply for forgiveness is 10 months after that October 25th, 2020, or that would be August 25th, 2021. So we have plenty of time to apply for forgiveness. Now, I've got some people that just can't sleep at night if they owe money to the bank. But I can tell you, in my experience, and again, this legislation keeps getting more and more borrower friendly. We have had no problems receiving full forgiveness. If you've got this money and spend it appropriately, we've got plenty of time to apply. There's a pretty good chance, I would call it 100% chance, you're going to get fully forgiven on that money. Thus, there's no rush or benefit to applying early. There's really no reason to get that going. Now, it's good to get it off our to-do list, and I know it's on our to-do list. And so if we're providing guidance or help to you on that forgiveness, the only thing is we've got to structure. We've got 65 clients to help, so it's not just one client. So we have to structure and build that work into other deadlines that we're facing, and so that's why we might be waiting. The other issue is that there was some speculation that the legislation was going to change. Let's say we're sitting in December 2020, that the legislation was going to change and make the forgiveness more favorable. Well, if you went and applied for forgiveness prior to that change, you could have run into some problems there, and I'll talk about that in a minute. What are the eligible costs? Again, we're going to go get this PPP round 2. The main cost that we're going to have for most of us is the payroll costs, especially if we pick the 24-week cover period. That's salaries, retirement contributions, group health insurance, state and payroll tax. Costs in excess of $20,800 to related to owner employees. That's the equivalent of the $100,000 cap. You cannot pay owner employees more than $20,833 over that covered period. Anything in excess is not counted in that forgiveness. Now, the one note that was interesting, assuming you pick the 24-week covered period, that same $100,000 threshold is a lot greater for associates. And so that they allow you to take that $100,000 and prorate that over 24 weeks, which ends up coming out to about $46,000. So that kind of beefed up the amount of money that we were able to allocate and pay out to associates or use in our associate pay towards that forgiveness. Again, you've got rent, utility payments, mortgage interest. Most people are just using payroll. The new legislation did add a couple of costs. I'm not going to dive too far into that, but one of them is related to payroll software related to accounting and payroll services. There's actually a new one that you can use related costs or expenses that are related to property damage and vandalism or looting due to public disturbances. That's an interesting one. But I guess if you had to shut down because your practice was vandalized and you weren't able to have people on payroll during that time frame or whatever, or able to work, that would be a relevant cost. There's also some supply costs that we can count. And so there are a couple of little things they beefed up or eligible expenses that we can use on this next round. What is our forgiveness experience? I have quite a bit of experience on this so far. Here's what I can tell you. Every bank is different. Some banks, it's crazy how different banks will interpret the rules here, but every bank is different. And so some banks are going to require more supporting documents than others. Some of the bigger banks have caused problems. I just got my first forgiveness back today from Chase Bank. But most of my clients that applied for forgiveness through Chase have gotten follow-up emails saying the information was insufficient, which I don't know what else we could provide to prove that point. And so some banks might be a little prickly on this information that we're supposed to be uploading. Most banks are using an online portal. And again, on the big bank thing, we're just going to have to fight through that and get it done. I did get my first full forgiveness back today, so I'm confident that they will see that through and get that done. Most banks are utilizing some sort of online portal to apply for forgiveness. They send you a link, you apply through there. Some of the smaller banks literally just send the application to the doctor and ask for supporting documentation. We send that over and they submit that to the SBA. The banks that have pushed our forgiveness applications, the ones that we have helped with through, and the ones that accepted our supporting documents without any other additional information, have received 100% forgiveness from the SBA with no problem. So I know that we have a good read on what the SBA is looking for. We can't help it though if the bank causes problems or creates a barrier in between us and the SBA. And so again, we're going to have to fight through that. But all the banks that have taken that application and support, we've had absolutely no problems on getting full forgiveness on that. The application is fairly simple. So I had one client that got kind of antsy and wanted to do this themselves, and which is fine. But I would hesitate for anybody out there that is a client that just can't wait for us to help. The application is simple, but it does come with some complexities. And so, for example, when they're calculating the total payroll cost during that time period, or what the eligible costs are for forgiveness, they all get to the same number, but every single bank has a different formula. And so you got to really kind of understand how to work through the payroll reports and figure all that out and extrapolate exactly what they're looking for. And so, although it looks fairly simple, there are some complexities that could cause problems. What is the documentation they're typically requiring? Payroll summary okay, so whenever you complete the application, they'll also request information to support or substantiate what you're telling them. So most of the time, I think this information here would cover most of that. A payroll summary by employee. So what I've been running is I take payroll report during that covered period, whatever the period we elect, and then I break it down by employee, what was paid to every employee during that time frame. And down at the bottom, it sums it up and gives us totals. And so they can see every employee that was paid and what they were paid during that time frame. Some will require a payroll summary for owner employees. So in other words, they want to see what the doctor was paid during that time frame. So I provide a report that pulls that out and shows that separately. 2020 Forms 941, 2020 state unemployment returns, and 2020 W-2s. For the most part, this has been a majority of the information they request, and it's all stuff that we've uploaded to your portal. The good news is, based on the latest legislation, the SBA will release a simplified forgiveness application for loans under $150,000. Now, in my experience, some banks, even though we apply in December, have been kicking back our application saying, hey, we're not going to accept this. We're going to wait for the simplified application, which is a little irritating because they don't have to wait for the simplified application to submit it to the SBA. I don't know why they're causing that problem. If they have the original application with all the supporting documents, they should be sending that to the SBA to get forgiven. But some are saying, we're going to make you wait until the simplified form is out. The SBA has not released that application. At this time, if you haven't applied, we highly recommend that you wait for that simplified form. We just don't want to duplicate work here on your part. We don't want you to have to run down these rabbit holes and get information if it's not going to be required. Under that new application, really, all the borrower has to do is certify the number of employees they had, the estimated amount of covered loan that was spent, and the total loan value. We believe that less documentation will be required. However, as with all of this stuff, if you read the fine details, I still feel like it gives a ton of room for interpretation on the bank. So really, it just depends on that particular bank and how strict they're going to be on that. So we're hoping that this new round will alleviate some of the documentation and some of the back and forth. Like I said, if they accept our paperwork and send it to the SBA, we've had no problems. But what happens is the bank comes back and says, hey, we need to see this. Hey, what about this? Oh, can we add this? And it's just like, hey, you got what you need. And so I don't know that this new provision eliminates some of the subjectivity of the banks in getting the documentation they need, but we'll see. Each bank should let you know when that simplified forgiveness form is available. This is the really good news. These two are really, really, really good news. Prior to this legislation, the money you receive, so I want you to think about this. If you got a $150,000 loan, you got $150,000 from the feds. Anytime you take in money, that's considered income in most scenarios. If I get $150,000, that's income, no matter how you slice and dice it, right? So under this legislation, it was pretty clear from the beginning that the money you received wasn't going to be taxable. Okay, so it wasn't going to be taxable. However, the expenses you paid for with that $150,000 loan, would it be deductible? So in a way, in an indirect way, that makes that PPP loan taxable, right? Because if I got $150,000, spent it on $150,000 of payroll, let's say, but I have to reduce my deductions by $150,000. Essentially, I've picked up $150,000 more of taxable profit. Okay, this new legislation came in and said the money's tax-free. You're not you can take the deductions related to the PPP funds. So that is phenomenal news. That essentially means that that money was free. The other thing about that though is a lot of CPAs, if you were running tax projections throughout the year, we assumed that that was going to be taxable when giving you your year-end tax projection data. Not all clients. Some clients at the very end, I gave them their projection stuff right when this came to fruition, so I was able to carve that out. But most of my clients, when I ran that year-end projection, I was under the assumption that you were going to have to pay tax on that money. So hopefully, some of us will get a nice little refund coming our way. I'm not going to guarantee anything. Every time I do that, I end up in trouble. But that could be either way, whether you get a refund or don't get a refund. The fact that you don't have to pay tax on that money is a huge, huge benefit. The other major issue here, and I don't know if you can remember back to the presentations we did back in May, but the EIDL grants, the economic injury disaster loan grants that you receive. And so businesses could get up to $1,000 per employee, not to exceed $10,000. It was initially thought that that money would reduce the amount of forgiveness on the PPP loan. So if you got a $150,000 PPP loan, you got a $10,000 grant. The most amount of forgiveness you could get on your $150,000 loan was $140,000. Thus, that was going to leave you with a $10,000 loan with the SBA. Okay. This latest legislation came in and said that you no longer have to reduce the amount of forgiveness by the EIDL grant that was received. So that's great news. So that money is extra free money that you were able to get. Now, that being said, and this is one of the things that we want to we were really telling people you want to wait until the legislation comes out so you apply for forgiveness. If you applied for forgiveness prior to this legislation and received forgiveness notification prior to this legislation, you're probably in one of two spots. One, you now have a $10,000 loan with the SBA, right? Because you already went through that process. If you're in that situation, you should be able to work with your bank to get that forgiven. I don't think that's going to be a problem at all. That's not a big deal. But you do not want to pay that back, because I had a lot of clients that were planning on paying that EIDL grant back once they got forgiveness. So if you're in that situation, you got forgiveness and you have a $10,000 loan with them, and now all of a sudden they've added this provision to this legislation. You just need to work with your lender to get that forgiven and removed from your account. If you applied for forgiveness, received forgiveness, and then turned around and paid your EIDL loan back, which you wouldn't have had to otherwise, I don't think it's the end of the world. I do think there will be a solution for those people. Like I said, throughout this legislation, the feds have made it more and more borrower friendly. I do think there will be a solution for that, but I think it's going to be on the back burner of the SBA to get that figured out. So we just need to know that and keep working with our lender and our banker to try and figure out how do we get that EIDL money back, because you were entitled to that money. I believe that is all I have tonight.
Well, we'll keep things moving along. In addition to the PPP2 and the PPP forgiveness questions, many of our clients continue to find that their staff members or even themselves are, in a situation where they're being affected by COVID-19, either from sickness, needing to be home with kids, that sort of thing. So we get a lot of questions about what people call COVID pay, or the emergency paid sick leave. And there's been some expansion and extension of that program as well that came out from the CAA. So Michael's going to help us cover that.
Thanks, Jeff. Yeah, so something that you guys may have heard about is there has been an extension of the emergency sick pay under the Families First Coronavirus Response Act, or FFCRA. So this was a requirement for all covered employers. So through 2020, this was a requirement for any employer with under 500 employees through the end of the year last year. So that was extended through March 31st, 2021. However, in the language, that's optional and not a requirement at that point. So one thing to note, employees are immediately eligible for the emergency paid sick leave. They do have to be there at least 30 days for the expanded family medical leave that we'll talk through in a minute. But anybody is immediately eligible as an employee for this program. So under the FFCRA, an employee qualifies for paid sick time if the employee is unable to work or unable to telework. I know we had some discussions with offices where they had some employees that were able to continue to work from home if they had front office positions. But if an employee is unable to work for any of these reasons listed here, they're eligible for the emergency sick pay. So it's going to be subject to the federal, state, or local quarantine or isolation order related to COVID-19, advised by a healthcare provider to self-quarantine, experiencing symptoms and seeking a medical diagnosis, caring for an individual that is affected by provisions 1 or 2, caring for a child whose school or place of child care is closed related to COVID-19, or the last one is experiencing other substantially similar conditions or symptoms. One thing I will note where we've gotten questions and had issues with some offices where they felt like employees were potentially trying to take advantage of this program was when employees were just deciding to stay home for 2 weeks on their own and not seeking any kind of medical diagnosis, operating under doctor's orders, et cetera. If you have somebody that decides to quarantine on their own and is not seeking a medical diagnosis, doesn't have a doctor's orders to quarantine, they are not eligible for the emergency sick pay. And that's from the Department of Labor procedures. So how long can they take off? So basically, if it's for any reason except for caring for a child because their school is closed or their daycare is closed, a full-time employee is eligible for up to 80 hours of leave. A part-time employee is eligible basically for the number of hours that they typically work over a 2-week time period. So part-time employee is going to be anybody that's under 40 hours a week. For any of you that have employees that work variable schedules, so for any hygienist, assistants, people that work irregular schedules, it's what their expectation is over 2 weeks. And also, if you need to do a 6-month average, that's an okay way to calculate the number of days as well. It's also important to note that they're only eligible for up to 80 hours of emergency sick pay for this program, even if they have another qualifying event. So if they're forced to quarantine because they're experiencing symptoms or they have COVID and they're paid out their 80 hours while they're on vacation for that, not vacation, excuse me, if they're paid out for the emergency sick pay for that, and then they have another situation arise where they're having to care for a family member or child with COVID, they can't be paid another 80 hours for that second one. So it's only 80 hours total for all applicable provisions. Now, they do have the ability to split that time if needed. So from a provision standpoint, you can take the paid sick time until you've used all of your time or until there's no longer a qualifying event. So if you're eligible for up to 80 hours and you're paid 40 hours because you have a qualifying event, and then you're able to come back to work safely, and then you have another qualifying event, as long as the time period hasn't elapsed, then you're able to take that additional time. So for reason 5, where you're having to care for a child with childcare because their childcare is closed based on COVID, full-time employees are eligible for up to 2 weeks of paid sick time plus an extended 10 weeks under the emergency paid sick leave. Part-time employees eligible for their time that they typically work. It is important to note for qualifying reason 5, where you're having to care for a child where their school is closed based on COVID or daycare, small businesses with fewer than 50 employees may qualify for an exemption to have to pay under those provisions. So it basically says if it's going to jeopardize the viability of the small business as a going concern, you can opt out of paying under the provision where you're having to pay for childcare. So on calculation of pay, So how much do they get paid under this provision? So for somebody that's qualifying for these 3 reasons listed here. So if they're subject to a federal, state, or local quarantine or isolation order, if they're advised by a healthcare provider to self-quarantine related to COVID-19, or if they're experiencing symptoms and seeking a medical diagnosis, they are eligible for their regular rate up to $511 per day and $5,110 in the aggregate over that 2-week time period. So a couple of things to note on this with regards to highly comped employees or salaried employees. So you may have to go into the payroll system and adjust the rate to an hourly rate to equate to this total if they're going to be over that amount. Some systems aren't intuitive enough to cut it off at that limit. So for anybody that's paid more than that amount, you may have to adjust the rate down. And if it's a salaried employee, you're most likely going to have to convert that to an hourly rate in the system for that. It is 2/3 regular pay, up to $200 per day if you're caring for an individual that has COVID, is quarantining based on that. $200 per day and $2,000 in the aggregate. And then the next slide is if you're caring for a child, if you've got a child whose place of business or place of schooling is closed, then you get 2/3 of pay up to $200. It's $12,000 if you do get that extended family medical leave. Again, you can opt out of this as well. Now, an important thing to note on the child care issue, if your employee's school is open, if they're having in-person class, but your employee decides to do school from home as a safety procedure, or if they're not comfortable sending their kids to school, unfortunately, that doesn't qualify under these provisions. The school has to be shut down in its entirety to be able to qualify. But again, as a small business under 50 employees, if it's going to jeopardize the going concern, you can opt out of this provision. Okay, so how do you actually do this? So one thing to note is it is a separate pay type and input column in most of the payroll systems. So you cannot just pay under the normal hourly rate and have this qualify to get the tax credit. It is a separate pay type and payroll input depending on what the reason for leave is. So before running payroll for any of these, please make sure you do notify your payroll provider so that they are able to get this set up in the system so that you can take advantage of the tax credit that goes along with this. So for the payroll tax credit, it is a dollar-for-dollar reduction on employer payroll taxes. So for many of you, after you run payroll, if you go in and immediately pay the payroll taxes, that's going to be the employer portion of Social Security and Medicare, and then federal withholding as well. It is going to be an immediate reduction of those taxes. So it is dollar-for-dollar reduction of your payroll taxes up to what you pay on the emergency sick pay. So from a timing standpoint, as far as how your payroll system may process this, it may be an immediate reduction of payroll taxes due. So with some systems, whenever you go in to pay the payroll taxes, it's an immediate reduction of payroll taxes due. You see that immediately whenever you go to process those. Other systems we've seen will actually build a credit throughout the quarter, and then it will reduce the first payment in the following quarter. So in the fourth quarter, if you had emergency sick pay that you paid out on this, you may have built up a credit in the system, and then it would have reduced the first tax payment due in the first quarter of this year. We did see at the very first of this year where some systems also hadn't been fully updated to have this flow through with the legislation that just passed at the end of December. So hopefully by now, with payroll running next week, everybody's fully on board as far as having this extension through the first quarter of this year. Last thing is documentation, whether you grant the leave or not, making sure that you have your files papered accordingly. So you need the name of the employee requesting leave, the dates for which the leave is being requested, the reason for leave, statement from the employee on why they're unable to work, and then the old proverbial doctor's note, name of healthcare provider and information from them that has advised employee to self-quarantine. Right, I think that's all I have on this, Jeff. Jeff, you're muted.
Perfect. Thank you. We did get one question, Michael, I wanted to see if you could help out with. The question was whether or not the paid leave that they're talking about here is in addition to any of the leave that they already received from their employer.
That's a good
Meaning,
question.
you know,
It's not in addition to, it's just an extension of when people can take that. So if there's an employee that had to quarantine last year and they used up their 80 hours, they don't have any more time or any more hours to use this year. It's just extending the time period where people can use that time.
And what about if they get hours already from their employer just as part of their normal employment package, sick pay, vacation pay, et cetera? Are they forced to use this first or that first?
They're not forced to use. In fact, it's a provision per the Department of Labor. You can't force employees to use their own time off before using this. However, you can supplement this pay with vacation time that they have. So for some reason, if they have qualified sick pay that they can take that's going to get them 30 hours this week, if they have other vacation or paid time off, sick time that they can use from the practice, they can add that to the emergency sick pay to have a full paycheck if they need to do that, but you cannot require them to use that first.
Michael, since the Act made this optional as opposed to required the way it used to be, is there any reason you can think of to why somebody would choose not to offer this?
Not that I can think of. I mean, it's basically a way to make your employee whole while they're out. If you're getting the tax credit equal to the wages, you're made whole as the employer. So it seems like a benefit that's worth offering to employees so that they're made whole during this, especially if they're under quarantine.
Excellent. All right. Thanks for that update. In addition to these updates, we're now going to discuss a little bit about the employee retention credit, which was sort of the stepbrother to the PPP program when it came out from the CARES Act originally. And with most clients, it didn't look like it was going to be something that would be applicable to them. But the CAA may have changed that. So we're going to go over to Jackson McDaniel now, who's going to give us updates on the Employee Retention Credit, or ERC.
Yeah, thanks, Jeff. That's exactly what I would describe as it has been the forgotten child of the CARES Act initially, because you start reading through it. I remember reading it initially and thinking, okay, this could make sense. This could have some dollars for our clients if they hit some of these criteria. But then it says very clearly, if you receive any payroll protection money, that you can't take the employee retention credit. Okay. The law that was just passed that we've been talking about actually goes back and strikes that, and it makes some other updates as well. So we're going to go through basically a refresher of what it was, because many of us kind of maybe read about it and forgot about it because it's not applicable, but now it's applicable for a couple different situations. Okay, so the refresher is that it is a 50% credit up to $10,000 in wages that's available to an employer if their business is either fully or partially suspended for the wages paid during that time period, and or if those receipts in the quarter have gone down by more than 50%. So a Q2 2020 versus a Q2 2019, if you have a more than 50% reduction in your receipts, you would qualify for this credit as well. Now, it's really important to note that it's $10,000 in wages per employee. Okay, so if you have 5 employees that you paid $10,000 and you're inside this qualified time period, you would actually get $25,000 of credits back to you. Okay, similar to the sick pay that Michael was just talking about. Those credits are going to be netted back out of taxes that you're paying in. Okay, so it might not come in a check in the mail for you necessarily, but it's going to be a reduction, something that you have to pay. These wages are going to be paid after March 13th, and it did end December 31st, and it's been extended out to July 1st as well. Okay, now the extension is on into 2021, and there are some updates for 2021 as well, but we're going to focus first on 2020, and then we'll focus on 2021 as well. One thing I do want to kind of point out as we're moving on to the next slide is who is excluded from this for us. Okay, so one really important thing is the owner is excluded. Okay, that's very important. I put the rest of this up here because this is actually on the IRS website. You cannot have a child, spouse, brother, sister, mother, grandparent, apparently. Basically, any sort of family member is going to be excluded from this as well. Okay, shouldn't be that big of a deal. Most of our clients have themselves on payroll, spouse. So basically, those two are going to be excluded from this calculation. Now, let's jump into the scenario that we think is going to be the most important. It's going to be the full or partial suspension because of COVID-19. Partial suspension, just FYI, this is going to be a classic example, is going to be a restaurant that maybe the dining room is closed, but the takeout is still going. That's going to be a partial suspension. I think for most of us, we're more talking about a full suspension, okay? The IRS does have a pretty strict definition that they have online about a governor, maybe like the county, something official that basically has a disruption to your business, okay? It's very important to note that this is not a voluntary suspension of operation. If you could have restarted your business and you didn't feel comfortable doing it, that does not mean that you get to extend this employee retention credit into your voluntary suspension time period, okay? Another very important thing is that if you read through the bill, it's kind of hard to pick up on this. It's only the period of starting from when the shutdown was to when you reopen. It's only wages paid in that time period. Now, we're still not 100% sure if it's going to be wages actually paid or maybe wages earned. Right now, we're going with the assumption of wages paid. So let's jump into some actual real dollar numbers here to see how this could affect you guys. Okay, so if we assume that the office has been closed down on 4/1 and then it reopens on 5/18, there's actually 4 pay periods here where you've actually paid your employees. Okay, you'll see here I've made a little bit of an illustration of on 4/3 is a little bit more of a full paycheck. The 4/17, 5/1, 5/15 are a little bit more smaller paychecks. Okay, so this is pretty clear. That during your shutdown, you get to take a credit up to $10,000 of wages per employee, which equals $9,000 of wages times 50% or $4,500 credit, okay? That's gonna be offset future costs. Like Miles said, this is as close to free money, just money in your pocket as you can get. The hardest part is just how to claim it. Now let's throw a little bit of a wrinkle in here just to kind of make this a little bit more complicated. What if you received your PPP money on 6/5 after your office reopened? This is actually a pretty clear example of there should be no issues in the situation that your office opened, then you receive your PPP money. What we're trying to avoid is a situation where the PPP money came in before your office reopened. So let's say May 2nd, so that your qualifying period for ERC overlaps with your covered period with PPP, okay? As you can imagine, the IRS, Treasury, SBA does not want to have duplication of benefits. Right now, it's unclear if we would be able to, fully take advantage of the ERC and take advantage of the PPP. What we're hoping is that we can take the end of the term, the end of the covered period, say we have plenty of wages here and we actually don't need these beginning wages and get a full credit. Like Jason said earlier, all the clients that we're seeing for forgiveness purposes over a 24-week period have only needed payroll costs, and those payroll costs have been way more than the loan actually was. So if we are allowed to do this, it's a pretty good route to get full ERC and full PPP forgiveness as well. Now, if we can't double up on this and the PPP was received before the office reopens, it would actually eliminate that 5/15 pay period. That would chop off about $1,500 in wages and drop your credit by $750. Okay, so that's going to be our scenario that we expect for most offices that would be applicable. All right, now let's fast forward to a little bit of the scenario where there's a 50% reduction, 50% reduction in gross receipts. Now, just a little bit of a refresher, we're going to compare Q2 2020 to Q2 2019. That 50% reduction will qualify you for Q2, but then also lets you qualify for Q3 as well. So it's way, the time frame that you're able to get it is a lot more favorable. It's a little confusing, the wording here, but the quarter will end whenever you hit 80%. So whenever you have 80% of your prior quarter or the comparable quarter wage receipts, that's when you're going to lose the ability to take the credit in the following quarter. So just to give you guys a little bit of an example, Q2, let's say that we have a 50% reduction. Q3, we have only a 15% reduction. Your ERC time period is going to end on Q3. If you have 25% reduction in Q3 as well, you actually get to push it out one more quarter. All right. So let's actually go through a very similar scenario that we just went through, except in this situation, we have a shutdown, but in this practice, there's also going to be a 50% reduction in receipts during Q2 as well. So like I said, that means Q2 and Q3 are going to be eligible. Now, the tricky part here is that we're going to have our PPP money that comes in as well, okay? So that means that we have a 2-quarter time period for the employee retention credit. We're going to have a 24-week period that covers most of that for PPP purposes. And so if we're able to start picking up all these pay dates, it's going to make our wages paid that are qualifying for the employee retention credit much higher. So let's just assume that we get no PPP money. We're going to pay $51,000 over this 2-quarter period, Q2 and Q3. We're going to have employee A that has $9,200. We're going to have employee B over $10,000, employee C over $10,000. So we're going to have a credit of $14,600 in this situation. That's with no PPP money. So this is, I guess, some situation where maybe the owner didn't take PPP money for some reason. They're focusing on the employee retention credit. So in that situation, it's $14,600. Well, let's just, similar to the previous scenario, let's make it a little bit more complicated. Most of our clients got PPP money. So in 6/5, we received our PPP money. Okay, so that calls into question our 529 pay period going forward on whether or not we can claim that for employee retention credits, right? So what we're hoping we're able to do, and the mechanics of how we do it, technical guidance is very unclear. This is just based upon the interpretation of the law and maybe a little bit of the intent, is that can we go to the end of that 24-week period and can we start backing out those costs, okay? And can we say, okay, well, we only need it until 9/4 or maybe 10/1 and still get our full ERC credit and then also get full forgiveness for PPP purposes, okay? So that's best case scenario for us, is that maybe this business got a $75,000 PPP loan. They can get full forgiveness for that $75,000 and get this $14,600 as well. Okay, so on to kind of the next point here. The coordination with other programs, like I said, we can't double dip on PPP and ERC. Okay, so how those are going to work together, the SBA, Treasury, IRS are going to have to come together and give us a little bit more guidance. I did not throw this wrinkle in either one of our other scenarios, but the sick pay leave that Michael was just talking about, if in that scenario you had an employee that was out and you paid them, you got 100% reimbursed for that payment already. You cannot include those wages in your calculation for the ERC. Okay, so you'd have to exclude sick pay from your ERC calculation as well. So we got a lot of potential things to watch out for to make sure you're doing this the right way. Okay. So we've dove into 2020, how that's calculated, what that looks like. Now for 2021, let's dig into what's different. Now, I guess before I jump into the details, from our pulling 25% reduction in revenue for our clients for PPP2, we do have a pretty good feel for who is able to hit this standard. It's a pretty limited scope for our clients, it's looking like, but we still want to go into it and jump into the details at least a little bit. So first of all, the credit percentage calculation has actually increased from 50% to 70%. So instead of needing $10,000 of wages, you actually need a little bit over $7,000 to still get the max credit of $5,000. Previously, you were capped at $5,000 annually per employee. They've actually changed it to say $5,000 per quarter per employee. So you could have a situation where you max out for an employee in Q1 2021, and if you still qualify, you can max out that same employee in Q2 2021 as well. Now, how you qualify is a little bit different as well. There's still the shutdown, but really the more important thing is going to be an 80% reduction in the same quarter of 2019. Now, it kind of makes my head spin just a little bit, but it makes sense. You're going to compare your Q1 2021 to pre-COVID 2019, okay? They don't want you to have to pull in a already low quarter in 2020, so they're going to say 2021 to 2019. Now for Q1, you could actually look back and say Q4 2020 to Q4 2019 and see if there's an 80% reduction, see if you qualify now. Okay, so those are all really important things to know on changes for 2021. Like I said, I don't expect this to be super applicable for most of our clients. Really, the shutdown situation is going to be a little bit more important. Perhaps the Q2 with a Q3 might hit some of our clients that were a little bit harder hit. Now, just a couple of final notes here. The tax impact for this ERC is still that it's essentially going to be a taxable benefit. The credit is not technically taxable, but the offset of wages that you're using to get the credit will not be deductible. This is essentially where PPP was before the law. So basically they went in, they changed how deductible PPP was, but they didn't change other benefits like the ERC or sick pay, okay? So you do get a benefit. It does essentially increase it'll be offset by taxes just a little bit. It's still a net benefit for you. How to claim this credit? Many of you are probably sitting out there wondering, okay, well, how do we get our hands on this $4,500? That's a great question. It took until October, November of last year for the IRS to roll out a 941X that would amend your prior 941s to be able to claim this. That time frame took them a couple months to get to that point. So I don't have really high hopes of a very clear guidance on how we do this. I do know that there's a 2-year window from when you filed a 941 from when you can amend it. So roughly we have probably about a year and a half, maybe a little bit less to file for that amendment. We don't want to wait until the end of that time period, but we do have a little bit of time. We do have perhaps a little bit higher priority things to do, PPP2, that type of thing. But whenever we have a game plan, we'll be working on calculations. We might need key information from you when you're shut down, when you're reopened, confirm when you receive PPP money, that type of thing. And they do calculations combined with your forgiveness as well. So those are the big updates for the employee retention credits that are applicable for you guys.
Hey, Jackson, I had to step away for a minute. Do you mind going over all that again?
The whole thing?
Sorry. No, it's you unfortunately drew the stick for the most dense material tonight, but I know that was a lot to get through. Joking aside, a lot to cover in that, a lot of math. I think probably a lot of people at some point just kind of said, I hope that you guys have got me covered here. Is it fair to say that regardless of whether it's going to be the shutdown time frame that we're looking at, assuming that we have those dates exact for our clients, or the 50% reductions that teams are going to be working in the background to come up with what the best solution is going to be, at least for our MLW clients, let them know what that's going to be. They don't necessarily need to know all the ins and outs here. We'll basically give them instructions. The point is there's more money that may be available. We're going to be looking for that money.
That's exactly right. I would say if we had a game, if we knew how to do it today, we would roll it out. I think there are some things that we know today, but there are things that we need to figure out and understand how those play together. Like Miles said, there's a little bit of interplay here on the forgiveness side of things. So we want to make sure we understand all the components, but we're definitely have it on our radar, and it's definitely similar to PPP1, PPP2. We're going to have a rollout, team by team, firm wide on how to calculate this, how to claim it for clients for sure.
Excellent. We did get a couple of quick questions. Will this be something retroactive? So, obviously the dates have gone by in 2020. Well, if you qualify, will we be able to go back and access that money from that time frame, or is it only for?
Yeah, so this is definitely a retroactive change. This law was freed up on 12/27 of 2020. So I think the intent was definitely that you go back and fix it. And honestly, there's lots of language that they have that they want to say, hey, we want to get you this money as fast as possible. There's ways that you can file forms for advances to reduce taxes. I would say the execution of that is very difficult, and I haven't really seen very good guidance on how you would actually be able to execute that strategy to get that money as fast as possible, which is unfortunate for those that might need the money. For those that have PPP money and other sources of money, then yeah, we do have a time, probably about 1.5 years that we're looking at that we'd be able to amend that. I don't expect us to wait that long, but we do definitely have time to wait for guidance, get more information, gather the facts, and then make a game plan.
During that spring timeframe last year, it wasn't uncommon for offices to be shut down for routine appointments, but still maintain or be open for emergencies when those would come up. To your knowledge, do you know how that would play into the requirement for shutdown, and if that time frame would work inside the ERC, or if they were open at all, then it wouldn't be
that is
eligible?
a perfect example. So there's actually it says fully or partially shut down. So that would 100% qualify under the shutdown criteria for the times that you were partially shut down. Now, once you're fully, able to have everyone in the office, then that's when that criteria would end. And then if you needed more time beyond that, you'd have to go to the revenue reduction side of things. But yes, that's the same scenario as a restaurant that has only takeout open and their dining room is closed. That's a perfect analysis. Yes.
Excellent. All right. I appreciate your work on that. I know that was a tough topic to get through and a lot of research went into that. We're going to switch gears. We are almost done for this evening. We're going to go to our last panelist. That's Chris Carroll. Chris kind of got the miscellaneous grab bag of items that remained in the CAA. So a few quick hits, including EIDL and some other things that might be relevant to some of you out there. So Chris, take it away.
Yeah, thanks, Jeff. I appreciate you guys hanging in there with us tonight. I know it's a lot of information. It's confusing, it's dense, or it can be. So we have a little bit of a 2020 hangover going on here, but there is hope for what's to come. I just want to go quickly through a few last minute items here, and I promise I'll move quickly through this and kind of keep each one brief. First thing here, real quickly, is this business meals deduction. You may have heard of this. It's sometimes called the 3 martini lunch. It's kind of back. So what happened was we had our tax reform a couple of years ago, went into effect in 2018, basically expanding the category of business meals that are now going to be 50% deductible instead of 100% deductible. That's what the tax reform did. Basically, the new legislation for tax years 2021, this year, and next year, a lot of those meals are back into the 100% category. So that just means a little bit extra business deduction, a little extra tax deduction for our business meals. Of course, those need to be bona fide meals with a business related purpose. And we're going to continue tracking by category, because we want to know if these meals are marketing related. Are these related to staff costs because you brought in lunch for the staff for a meeting, or you had a staff event, or is this just another type of business related meal, like when you're traveling or on continuing education or something like that. So we'll continue tracking those by category, but it is nice that more of those are going to fall into the 100% category now. For an example, if you have about $250 a month that have been falling into that 50% category, that's $3,000 a year. So you're getting an extra $1,500 of tax deduction. So it's not an enormous swing in your taxable income. You may be saving a few $100s here, but it's also not nothing. So it's a pretty nice little change in the law for the next couple of years. Next, we move to charitable contributions. So you may have heard about this in 2020. It's actually in place for 2020. They've done this again in 2021 now. So any contributions made in 2021, there's a new above the line deduction. So again, if you look back a couple of years when the tax reform happened, one of the things that happened was the standard deduction was raised significantly to the point that a lot of people that used to itemize their deductions no longer do that, which means a lot of times for those people that are no longer itemizing, these charitable contributions aren't moving the needle anymore. They're not changing their taxable situation. They're not getting that deduction because they're getting the higher standard deduction now. So the nice thing about it above the line deduction is that you will get this charitable contribution deduction regardless of whether you take the standard deduction or itemize. So for 2021, it's $600 for our married filers. If you're single or any other filing status, that'll be $300. In 2020, it's only $300, even if you're married. They kind of fixed that. You know, people were calling that a penalty for being married because there's two of you, but you were still only getting $300. They fixed that for 2021. So we've got some charitable contribution deductions that if you are a standard deduction person, you might not have otherwise gotten. So that'll be nice for this for a couple of years here too. So let's talk a little bit about FSA. So this is flexible spending accounts. There's two different kinds. There's the dependent care flexible spending account or a healthcare flexible spending account that you may have with your employer or your spouse may have with their employer, something like that. I do want to point out immediately, this is not the health savings account, HSA. I'm not talking about an HSA. I'm talking about an FSA, even a healthcare FSA. So these are typically use it or lose it in character, which means you've got to use the funds that you put into the FSA. You've got to use those funds by year end or you lose them. As opposed to an HSA where you can actually accumulate within those accounts. So previously, employers had the option to allow a small amount of unused funds at year end to be rolled to the following year. Or there's a little grace period in there to where if you haven't used up all your funds, you've got till March 15th or something like that. So there's been a small grace, a little bit of wiggle room. However, given the unusual circumstances of 2020, a lot of people either miscalculated their FSA contributions, or they just simply didn't use them all because of shutdown or coronavirus or whatever. So this is particularly true if you had a dependent care FSA. And then you ended up not using near as much childcare expenses that you normally have. So the nice thing about this carry forward is that now unused 2020 balances. So if you had a balance in an FSA 2 weeks ago, that can now be rolled forward, carried over to 2021. Same will be true of this year. If you have unused balances at the end of 2021, that also can be rolled forward to 2022. Now, this won't always be the case, so don't just plan on accumulating cash in your FSA like you might be doing with your HSA as accumulation account, but it will be nice here for a couple of years. And I do want to point out the employers are allowed to adopt a policy like this to where they'll allow this rollover, but they're not required to do so. This is definitely something, if you have an FSA and you do have unused funds, check with your HR person, your HR department, just to see if they're adopting this policy or not. So on the next slide, let's talk real quickly about some SBA loans, not PPP loans, not EIDL loans, but other types of SBA loans. So if you had an SBA 7A or an SBA 504 loan or something like that, that was already in place prior to the pandemic, you should have been receiving 6 months of payments paid for you by the SBA. It's a great benefit, principal and interest payments, not just deferment of payments. These payments were actually being made. Your loan balance should have been being reduced because these payments were being made by the SBA on your behalf. So if that was in place prior to the CARES Act, should have already been getting 6 months of payments. If you weren't getting that, make sure you reach out to your the SBA or your SBA lender or your planner here, and let's get that part rectified. But the cool thing about it now is those people that got that relief in 2020, you're about to get a little bit more. There's going to be 3 more months starting in February, 3 more months of payments made. That's going to be capped at $9,000 a month, but still that's another $27,000 potentially payments that will be made on your behalf by the SBA. So this last point on this slide for new loans. So there's a little bit of a discrepancy about what exactly this is going to look like. And the SBA, of course, they're underwater and don't have updated information released on this yet either. So we're still kind of waiting on some additional guidance here. But indications are that even new loans will get the first 6 months of principal and interest payments. Now, this date, September 20th, 2021, I've seen multiple dates here thrown around. I've even seen as long as the payments are made by the end of September, your 6 months of free payments are made by the end of September on a new loan, then you get those payments. But once we're past September of 2021, no more payments will be made, which means, of course, if you want all 6 months of those loans would have to be in place by March of this year. So actually future loans might also get this benefit as well. All right, let's talk about the EIDL. We've referenced this a little bit, so I'm not going to belabor the point here, but I've got this slide that talks about the loan itself. So I want to divide the loan, the EIDL, the actual loan, from the grant or the advance. And Jason talked about the grant just a little while ago. First, let's talk about the EIDL. This is really just review. It's not a forgivable loan. The deadline has been extended to the end of this year, subject to availability of funds. So again, it's just the rest of this slide is just kind of talking about if you were doing the EIDL last year, we talked through this ad nauseum. If you were going to take this loan, it's a 30-year term loan at 3.75%. You get a year of payment deferment, but interest starts immediately. So there's some advantages. A lot of people were taking this loan to have a little cash cushion because we didn't know what was going to happen, and that kind of thing. So the loan has to be used on operating capital, working expenses, business expenses, et cetera, and you do need to track that very, very carefully because the SBA is going to have, you'll have a SBA officer assigned to your account. They are going to want to know how these funds were spent. So that's the loan. A lot of people got that loan, and if you're thinking, do I need to go get this? Keep in mind, this is not a forgivable loan. So who needs to go get it? Well, if your business is still in trouble, if you really need access to cash again, this is available again. So you can go get this access to cash. Now, perhaps you're one of those people that actually got this loan and you've just been sitting on the cash just as a cushion. You may be ready to start paying this back. If you need to do that, it's a pretty straightforward process. You can reach out to the SBA for that, or you can work with your planner here. It's a pretty straightforward process to go ahead and pay that back. If you're doing okay as far from a cash level standpoint, and you don't feel like you need to cushion anymore, pay it back so that you're not incurring those interest charges anymore. So the last thing I want to talk about is the EIDL grant. This is that advance. This is that, the first $10,000 that they offered, 9 months ago. Jason referenced this, that this is no longer to be deducted from your PPP forgiveness amount, which is great news. Those of you that were left with the loan after your forgiveness was granted, you should be able to get this rectified with your bank. Maybe just an amendment to your forgiveness application or something like that. But it's nice that that is no longer part of PPP. It's not interacting with the PPP at all. Now, the new funding for the grant is a targeted grant, meaning they're trying to target the businesses that are most likely really going to need this, and they're going to verify this. It's not just open to everybody again. So the SBA hopes to start accepting applications for this next week, but as you can imagine, they're quite underwater right now. So the priority for this grant, this targeted grant, is for small businesses that are located in low-income neighborhoods. So how do I know if I'm in a low-income neighborhood? It's the same eligibility requirements for something called the New Market Tax Credit. And that just means in your area, your community, the poverty rate is at least 20%, or your median family income is below 80% of the median income of your metropolitan area or your state or something like that. So you got to hit one of those metrics to qualify. And you have to have your business in place by January 31st of last year to be able to apply for this. You also have to prove that you experienced an economic loss of over 30%. So March 2nd, 2020 is a key date that they're looking at here. You'll have to compare revenue for an 8-week period since March 2nd with the corresponding 8-week period prior to March 2nd of last year and show that you had that 30% loss. That's kind of their line in the sand, so to speak, that you'll be comparing the before and after that March 2nd date. So the biggest question really at the moment is, am I even in a neighborhood that's going to qualify for this? And there are some online mapping tools out there to where you can sort of figure this out, but there's nothing that's real cut and dry yet that says yes or no. There's some mapping tools where you can go and pull this data to see if you meet these requirements, but there's still some figuring that you've got to kind of do on your own. So what I would recommend is let's just watch the SBA website for the next week or so to see if they get some more, get a good tool up there to determine that, or interact with one of the tools that are already existing as far as how that's going to work, and if you are in a low income neighborhood, if you're going to qualify for that. So you remember back when that grant came out, the original thought was $10,000, you're going to be able to get $10,000. Then the SBA immediately said, oh, well, up to $10,000, we'll give you $1,000 per employee. So it's possible your grant was only $7,000. And so the idea that you're wanting to top off this grant to 10, well, at this point, to be able to do that, you would have to meet these new targeted grant requirements, is kind of how that works. So I think that's about all I had on the EIDL. One point I did want to make was that if you got an EIDL already, you can't get a second one. Now, two eligible businesses could get two, but you can't really get a second grant, but you do have 6 months from either the approval that you got or the declination that you got. If you were declined and you want to reapply, you have 6 months to either reapply or request an increase to your EIDL grant. So there is that option. You just can't get a second one.
All right. Thanks, Chris, for wrapping all of that up for us. For whoever had 42 minutes over in the pool, I guess you win the big prize. Joking aside, I know it's a lot of information that we covered tonight, but it is our goal to keep you informed. And so, we want you to rest assured that we've got you. We're going to continue to gather information as it comes in, and we'll get that out to you so that you have enough tools to be able to take appropriate action whenever it is necessary. I also want to remind you that tonight's webinar has been recorded. We're going to get that uploaded to our website and to our social media as soon as we've had an opportunity to get that processed. We welcome you to share that with others that weren't able to join us tonight, or if you need to review that, it'll be available as well. I want to give a thanks to all of our panelists for the work that they put in tonight, as well as our planners that were answering questions in the background to those of you that were typing those out. But really, I want to give a huge shout out to all of our MLW staff members who've been working overtime over the last couple of days to analyze each individual client situation for purposes of eligibility for this PPP2 loan, and to be able to get all of that supporting documentation uploaded to you so that you are ready from basically minute one to go and apply as soon as your bank's portal is open. So a big thanks to all of you guys for putting in that work to help serve our clients. Also want to remind you that if you want to get faster notifications and updates, please make sure you're looking out for our firm-wide emails, and you can also follow us on Facebook and Twitter, where we'll post those updates as well. Other than that, I have been your host, Jeff Moss, and for all of us here at MLW, we wish you a great night.